Welcome to your customized deep dive. Today we are really diving into the engine room of the digital age, you could say. We're focused on Vertiv Holdings Co., ticker VRT. We've got their annual report, the latest Q2 2025 earnings transcript right here. Basically, we're going to unpack Vertiv's fundamentals, their financials, which are frankly pretty eye-popping right now and where they're headed, especially with this whole AI revolution demanding so much power and cooling.
That's exactly right. Our job here is to give you the quick synthesis of what Vertiv is today. I mean, they're a global leader in critical digital infrastructure, no doubt about it. And we want to understand how they're planning to ride these huge waves, data centers, AI that are, reshaping everything. So this dive, it's going to give you a clear picture of their momentum, which has been impressive in 2024 and even more so into 2025. But we also need to balance that against the, let's call them growing pains, the operational challenges they're working through.
Okay, let's unpack this then. For anyone maybe less familiar, Vertiv isn't making the actual AI chips. They're building the critical stuff around the chips, right?
Yeah.
What exactly do they do?
Yeah, precisely. Think of them as the leader in designing, building, and servicing the tech that powers and, just as importantly, cools the digital world. They offer end-to-end solutions that covers the whole, what they call the powertrain and the thermal chain.
Okay, powertrain, thermal chain. It sounds a bit like corporate speak.
Mhm.
Break that down for us. What are we actually talking about?
Sure. So the powertrain is everything managing the electricity, keeping the lights on, basically. Think AC/DC power conversion, big battery backup systems, UPS, uninterruptible power supplies, and things like switchgear, which are the big control panels managing power distribution.
Got it. Power side. And thermal.
The thermal chain is all about cooling, from, sophisticated air conditioning for data centers to really advanced liquid cooling, which is becoming critical. Plus, they provide the software to monitor and manage the whole setup.
And having that whole package end to end must be a significant edge, yeah. Especially now with AI making everything hotter and needing more juice.
Oh, absolutely. The reports consistently rank them #1 globally in thermal management and also #1 in what's called three-phase large UPS and power switching. That's the heavy-duty stuff. And this leadership plays across their main markets. Data centers, that's the big growth area with hyperscale, cloud, colocation, but also communication networks and regular commercial and industrial stuff too.
So the tech leadership is clear. What about the scale? This isn't some new player jumping in.
No, not at all. They've got a 60-year history. We're talking about 31,000 employees around the world, 23 factories, over 300 service centers. It's a massive global footprint. And maybe the most telling thing, their average customer relationship is over 20 years long. These are deep partnerships.
Okay, deep history, big scale. And they talk a lot about their internal system, the Vertiv operating system, VOS. Is this just another fancy acronym, or does it actually mean something tangible?
It's a fair question. Look, VOS is basically their playbook for managing all this complexity. The CEO, the manufacturing folks, they really emphasize it. It's about driving operational excellence, using lean methods for continuous improvement. What that means practically is shorter cycle times, better order management, especially for complex custom jobs.
So it helps them actually build and deliver stuff faster even when demand is exploding.
Exactly. It's how they try to turn that huge demand into actual shipments, not just a long waiting list. It's kind of their operational backbone.
Okay, that makes sense.
Yeah.
Now let's get to the financials, because this is where things get really, really interesting. 2024 was strong, but the Q2 2025 numbers, they show serious acceleration.
That's the story. So backing up to full year 2024, net sales hit just over $8 billion. That was up nearly 17% from 2023. And importantly, gross profit margin climbed to 36.6%. They managed to turn higher sales and better prices into more profit. Operating profit jumped almost 57% in 2024. Strong numbers.
Very strong. But Q2 25, that's the recent print. What are the highlights there showing this faster pace?
Yeah, Q2 25 organic sales growth was 34% year over year. That's a huge leap.
34%. Wow.
Yeah, the Americas were incredibly strong, up 43% organically. Asia Pacific also booming, up 37%. And look at the bottom line impact. Adjusted diluted earnings per share hit $0.95 for the quarter. That's up 42% from the year before.
Okay, sales booming, earnings booming. What about orders? That's the pipeline, right? The future revenue.
Right. And this is maybe the headline number. Q2 2025 orders topped $3 billion. First time ever. That gave them a book-to-bill ratio of 1.2x.
1.2. So for every dollar they shipped, they booked $1.20 in new orders.
Exactly that. They're bringing in business much faster than they're shipping it out, which, is a good problem to have, mostly. This builds on solid order growth over the last year, and the result, a truly massive backlog.
Amazing.
As of the end of Q2 25, it stood at $8.5 billion. Billion with a B. That's up 21% just from the year before. And management specifically pointed out that this backlog is very high and stable, with customers actually pushing for earlier deliveries. It signals really strong, sustained demand in the sector. It's like having years of work already sold.
That $8.5 billion backlog provides incredible visibility.
Mm-hmm.
Okay, let's shift gears slightly. Looking ahead, riding this AI and data center wave, what's the scale of the opportunity Vertiv is aiming for?
Well, the company sees the overall data center market growing at a very healthy clip, maybe 10 to 13% CAGR over the next 5 years. But the bit they're really focused on cloud and colocation that's projected to grow even faster. We're talking 15 to 17% CAGR, driven almost entirely by AI needing denser and denser computing.
And they're investing to keep up. You need serious R&D for that kind of tech evolution.
They are. The reports show $352 million spent on engineering, research and development, ER&D, just in 2024. So yeah, significant investment there.
And they've got a strategy beyond just building more factories, right? What are the key parts of their growth plan?
Yeah, it looks like 4 main things. 1, obviously, capacity expansion, building more plants globally. Can't avoid that. 2, strategic M&A. They mentioned buying a company called Great Lakes. That's about getting deeper into custom racks and cabinets, specifically for that AI infrastructure white space. Think specialized housing for dense gear.
Okay, capacity and acquisitions. What else?
3 is technology leadership. This is interesting. They talked about working closely with CoolWeave and Dell to support NVIDIA's next-gen chips, the GB300 and VL7. They actually said this positions their infrastructure at least 1 GPU generation ahead.
1 generation ahead. What does that actually mean in practice? Sounds impressive, maybe a bit technical.
It means they're not just selling off-the-shelf coolers. They are working with the chip and server guys to figure out how to cool these incredibly powerful, incredibly hot new GPUs before they even launch widely. It's about solving the heat problem proactively, especially with advanced liquid cooling. They're embedding themselves in the design process.
Which leads to the fourth point, I think. Services.
Exactly. Management believes that as these cooling systems get more complex, especially liquid cooling, the need for their specialized thermal services contracts will grow. More complex tech needs more expert support. Oh, and they also mentioned things looking positive on the regulatory front in Europe, EAA, regarding AI infrastructure investment, another potential tailwind.
Okay, incredible top-line growth, huge backlog, tech leadership. But there have to be challenges. The Q2 adjusted operating margin dipped, right?
Yeah.
18.5%, down about 110 basis points year over year. What happened there?
Right, that's the counterpoint. Management flagged 2 main things. First, the ongoing net impact of tariffs. It's kind of a known headwind. Second, and probably more significantly in Q2, were higher than expected operational inefficiencies, execution challenges, basically, meaning the costs associated with ramping up production so fast. Things like supply chain snags, costs of getting new lines running smoothly, essentially the friction of growing at breakneck speed. Their manufacturing system was straining a bit.
Okay, growing pains. But management sounds pretty confident they can fix this quickly. They said, materially resolved by year-end and are guiding for Q4 margins over 23%. That seems optimistic, given the scale of the ramp.
It is optimistic, but they believe they have the levers. Their confidence seems based on, 1, VOS eventually smoothing out those factory-level issues as the new capacity matures, get the system running right, and 2, the sheer scale of that $8.5 billion backlog providing operational leverage. Basically, higher volume should eventually absorb those temporary ramp-up costs.
So they're betting the volume will overwhelm the inefficiencies.
Pretty much. Hitting that 23% plus margin in Q4 is key. It keeps them on the path to their longer-term goal of 25% adjusted operating margin by 2029. But you're right, to flag it, executing that margin recovery while still growing like crazy is their biggest immediate test.
Makes sense. And just quickly, overall financial health. Balance sheet, any other big risks disclosed?
Financially, they look solid. The net leverage ratio, debt versus earnings, was down to 0.6x in Q2. That's very low, very healthy. Shows they have the financial muscle for these investments. Debt levels seem manageable. Liquidity is good. On the risk side, beyond operations, they do disclose some ongoing legal things, a securities class action lawsuit, some shareholder lawsuits, and an SEC and U.S. Attorney's Office subpoena.
Related to?
Related to allegations about past disclosures around pricing and supply chains. Standard stuff for large companies sometimes, but worth noting. Management says they have strong defenses and are dealing with it.
Okay, so wrapping this all up, for you, the listener, wanting the key takeaways on VRT,
I'd say Vertiv is riding a powerful wave. It's a turnaround story hitting its stride right as demand for its core products explodes, thanks largely to AI. That huge $8.5 billion backlog gives them a major safety net on revenue. The big if right now is execution. Can they translate that massive demand into profit margin growth by smoothing out those operational bumps and managing tariff impacts? They seem very confident they can, especially by year end.
And that confidence is reflected in the guidance, right? They significantly raised their full year 2025 outlook, now targeting $10 billion in sales, adjusted EPS around $3.80, and $1.4 billion in free cash flow. That's a big statement.
It absolutely is. So the story is really one of market leadership in a vital, fast-growing sector. They're using their scale, their tech like VOS and the advanced cooling work to try and master the increasing complexity that comes with powering AI.
So here's something for you to think about. Vertiv's edge relies heavily on integrating these increasingly complex power and cooling systems, staying, as they said, one GPU generation ahead. If this infrastructure complexity keeps accelerating as fast as the AI chips themselves, what new advantages, beyond their current scale and VOS system, might they need to develop to truly stay ahead and lead the industry over the next, say, 3 to 5 years? Something to ponder.